Welcome everyone to our 2022 year-end tax planning webinar. This is probably my favorite topic. We're going to go through a few strategies and ideas that we can all implement before the clock strikes midnight on December 31st. So excited to be here. Welcome everyone, and we will jump right in. So before we get started, just want to make sure that you're aware that we're going to talk about an array of tax planning strategies. However, we always advise that you speak with your CPA, with your advisor, to make sure that these things make sense for you. Everyone's circumstances are different. And while the strategy may sound like a great idea, it may not necessarily make sense for you. So because of that, just be aware that these are general ideas, and if you have more questions, please feel free to call us or speak with your CPA to make sure that these things make sense for you. So I am, as you may all know, my name is Marianella Collado. I'm the CEO and Senior Wealth Advisor here at Tobias Financial Advisors. Today, I'm excited to present Lonnie. Lonnie is our Director of Tax Services. So I get to share my tax hat. Actually, not share. I'm going to give him the tax hat. And basically, Lonnie's role here with Tobias is to make sure that he is at the helm of all tax planning strategies, sitting with our clients, whatever questions come from the client or issues that arise, we bring Lonnie in. So he's going to lead all tax-related operations for the firm. He brings with him over 10 years of experience in personal tax and accounting service, both compliance on the domestic side and international. Prior to coming to Tobias, Lonnie was a partner at a top 10 South Florida public accounting firm. So we're so excited to have him on board. This is going to be what I call a game changer for the whole team, because we get really able to lean on Lonnie for a lot of the heavy tax issues that we deal with on a daily basis at the firm. So welcome, Lonnie. This is your big debut, and we're going to have fun talking about some year-end tax planning strategies.
Well, thank you, Nella, and it is a pleasure to be here. I'm very excited to join the Tobias family. As you'll see when we get into the presentation, there really is a big difference between tax compliance, what I've done for the last 10 years, and tax planning. Totally different worlds. So I do look forward to using my experience in tax compliance and coupling that into this new adventure called tax planning that I really feel is going to be a great experience for me, and hopefully, like you said, a game changer for the Tobias clients.
Excellent, excellent. So let's jump right in. We'll make this totally conversational. And on the topic of conversational, you'll see that you do have the option to ask questions. You can do it real time, and if it's related to the topic that we're talking about, we'll go ahead and address it. Otherwise, we'll take some time at the end to try to get to all of your questions. And if we don't get to your questions, please, we like talking tax, so don't be shy about reaching out. So with that said, let's jump into, and really, Lonnie, I think I'd want you to maybe walk us through on why do we need to do year-end tax planning? What's the importance of doing this at year-end, and what exactly are we trying to do when we talk about year-end tax planning?
Of course, Nella. So again, kind of what I hinted on in the in the introduction before, tax compliance and tax planning are two very different things. Most people think of the concept of doing their tax return, filling in the tax return. Maybe their CPA does some projections for them to see what taxes they might owe at the end of the year, or get them penalty proof, as some people have heard that term. But tax planning, totally different time of the year that this happens, as far as the things actually getting set into motion. Again, keep in mind, this is a holistic type process that's customized to each of our clients, and it happens throughout the year. But really, at the end of the year is your last effort to get these things done and get it done within the calendar year, and really maximize whatever's available to you. So it's critical to understand the time frame of when different things need to be done in the tax planning world. So and obviously the overall goal is save taxes and maximize every single thing that we can for the clients to, you know, to save the day.
Excellent. And maybe let's talk a little bit, why is it so complicated? Is this something that I can just go and do on my own? What is so complicated about year-end tax planning that we dedicate a webinar to it, and we dedicate the last 2 months of the year for year-end tax planning for our clients. So let's talk a little bit about what's so complicated about it.
Well, number one, it keeps changing, so that doesn't help things. And obviously, the state of the economy, the world, the country, everything kind of plays into the changes that do occur. And I used to say, hey, this is something that changes on an annual basis, but now I feel like sometimes it changes within the same year. So we have to constantly be on our toes to be on top of these changes and make sure that we know how to plan accordingly for our clients. Secondly, why is it so complicated? Again, it's not compliance. Every single client is in a different situation. They're in different income levels. They have different tools that are available to them that they may not even know about. And it's for us to look into these things and on an individual basis do the planning.
Excellent. And then when we dive right into tax planning, which, maybe make it a little bit more granular to folks that are here and may not understand what exactly does that mean, tax planning. What are we analyzing? Are we running projections? What do the projections look like? But maybe talk about when we do all this, what is our overall goal after we've done putting all these numbers into our system? What is the goal at the end of the day?
I mean, I guess it's there could be multiple goals. The overall goal is to save on taxes, and nobody wants to pay taxes that they don't need to be paying. And it's our plan and our goal to try to maximize every avenue that we can to avoid paying unnecessary taxes. And again, the second part of the goal is the timing. It's all about timing with this stuff. And December 31st versus January 1st could cost a client tens of thousands of dollars and missed opportunities.
Yeah,
So
so
yeah.
I used to laugh, Lonnie, because sometimes we'd reach out to people and they're like, "Oh, we'll do that in January and February when we're doing our taxes." And I said, "Well, unless we have a time machine, there's no way we can do year-end tax planning the following year." So the timing, as you said, is critical. So let's dive right into some tips. I think we kind of summarize it into some top tips that we should be looking at. So what would you say is very low hanging fruit that everyone should be looking to do with respect to retirement savings?
Well, first off, I mean, as you can see on the slide here, if you have a 401k available for you with your employer, you should contribute to it. Again, like it says here, contributing up to the company's match is free money. I mean, in reality, you should be doing that. And if your cash flow allows you to, you can contribute all the way up to the maximum, which is a tax savings. It's all pre-tax dollars. So it definitely makes sense to utilize 401ks. And I guess one thing for people to note is there's other vehicles available, lots of different vehicles besides a 401k. There's simple 401ks, or there's Roth IRAs, which we'll talk about later in the presentation. So it's important to know in detail the client and our client's situation before we can actually go in and make recommendations. And sometimes we might do two or three different things with a retirement plan. So that's what I would say. If you have it available to you and you can afford it, you should be doing something, at least one thing.
Yeah, I love what you said. There's a variety of things that people could be mixing and matching and doing together. I like to look at saving strategies in the form of like, filling up different buckets, and that bottom bucket almost being your employer provided plan up to the match, because essentially, you don't want to leave money on the table. So, kind of filling up those savings buckets. And the idea really, Lonnie, and maybe we can talk a little bit more about that, is kind of accumulating this nest egg for retirement. So all of these different tips, tax strategies are all part of the overall plan to help someone live the life they want to live, whether that is retirement or just having financial freedom. So essentially, look out for your employer provided plans, see what the maximums are, and cash flow permitting. And this is when you speak to your planner to see how much you can really afford to set aside and still be able to meet all of your current needs. So
Yeah.
you had mentioned Roth conversions, Lonnie. Let's talk about why this is one of the creme de la creme savings account. Let's talk a little bit about Roth conversions and what that means.
No, of course. And like you saw on the last slide when you're talking about a tax deferred account, you're kind of saving the taxes now, maybe when you're in a higher bracket, and kind of kicking the can down the road for when you retire and start taking it out. But what if you can actually grow tax free? So that's the beauty of a Roth IRA. And one of the tools that we use for a large amount of our clients, especially when the timing is right, is to convert into a Roth account. And I guess there's a little bit of a misconception of, low tax bracket versus high tax bracket, or when you can do it. And really, it's different, as we're going to say this whole presentation, it's different for every client. But it could typically be a really good tool to use. And that being said, there's even tools that we can use to kind of do an analysis and see, okay, this is the amount of tax it's going to cost you now on the converted amount, and this is what it's going to save you in tax-free growth down the road. So there's a lot that we can do with this, and it's a great strategy.
Yeah, and I think it's not something that someone should be doing blindly. I think you have to see where this fits into your overall plan and even your legacy planning. Who's set to inherit these assets? Who are we prepaying taxes for? Because essentially, a Roth conversion is the action of paying off the IRS earlier than you need to in order to have that tax-free growth in the future. So I think this really needs to be aligned with your goals and your overall legacy plan. And I'll give you an example. I met someone and she says, my CPA just told me to start doing Roth conversions because the rates are only going to be higher in the future. And I said, okay, tell me a little bit more. Let's talk about your overall plan. Who's set to inherit all these assets, because she had no kids. She said, well, no one. I'm going to just give everything away. It's going to a charity. So then we said, well, okay, why are we prepaying taxes on assets that are essentially going to a charity anyway? So this is why we say Roth conversions sound like the next best thing since sliced bread. And it is, it's amazing. It's an amazing opportunity, especially after the Secure Act. And we'll talk a little bit more about what Secure Act did, but it has to make sense. So if the plan is that you're going to leave your IRA to charity anyway, then why are we prepaying taxes? Because effectively, we need to model out when we make up for that prepayment of tax, right? What is the break even on us paying taxes now versus later? And when does that tax-free account grow sufficiently more than the taxes we paid today? So that's an important conversation that just can't be looked at in a vacuum. So I did want to touch a little bit on Secure Act, and I don't know, Lonnie, if you want to tell us a little bit about before Secure Act and after, and why Roth conversions became such a popular thing after the Secure Act.
No, of course. So, with the Secure Act, when it came out, what they required is a full distribution of the account to the beneficiary within 10 years after the date of death. And the reason why the Roth conversion became such a great tool during this time is 10 years is kind of really accelerating something that maybe would have been over, you know, 20, 30, 40 years, whatever it is, and there could be a significant tax effect anyway. This would be a good way of getting it into a vehicle that can grow tax free. So to me, that's one of the main points of it. And also, Nella, to a point that you made, prior to talking about the Secure Act, this is one of those things we'll talk about a lot in this presentation. It's very easy to, and this is coming from somebody in public accounting, it's easy to say, hey, you might have an opportunity to do a Roth IRA, but it's very different than actually doing models and looking at a whole situation and saying why it's the right reason to do a Roth conversion. So it's a different world in tax planning.
Yeah, we can stay here all day because Roth, there's so much to talk about Roth and how to do a conversion correctly. But in the interest of time, let's move on to another exciting topic. Let's talk a little bit about charitable giving and how the Tax Cuts and Jobs Act really changed the landscape on charitable giving and the deductibility of those gifts, and maybe how we can plan better given higher standard deductions. You want to walk us a little bit through the methodology there?
Of course. So, donor advised funds is this tool that can definitely be utilized for this. And, as you can see here, a bunching of charitable giving. When you're doing this, it's great to give to charity, and it's a great thing to do, but also you want to maximize the tax benefit, and you want to make sure that whatever you're giving gets you above the standard deduction so you can claim the additional tax benefit from it. In 2022, the standard deduction for a married filing joint, for example, is 25,900. So that's a number that you want to be above. And one great facet of the donor advised fund is you can put into it now and get the tax deduction and choose later where the organization you decide for it to get donated to. So it's a great vehicle to maximize the current year when you might be able to go above the standard deduction. And again, it's just another one of the things you have to do an analysis and see where you're at before making that call on that.
I like calling a donor advised fund my tax deduction parking spot, right? Because we're effectively locking in that deduction now. I think it's a great tool, and I think this is often overlooked because maybe they're not doing tax planning on across multiple years. And this is why tax planning, again, it shouldn't just be in a vacuum, just current year. I think we need to look at, well, what's happening next year, maybe a couple years down the line, so that we can better direct clients on when to make their charitable gifts. Excellent, excellent topic. So let's talk a little bit about, I like to look at this as maybe injecting a little bit of steroids or the cherry on top to using a donor advised fund. Lonnie, tell us a little bit about, yeah, so you've set up a donor advised fund because Lonnie told you that it's just a great tool to bunch all your charitable gifts in one year, but how can we boost that contribution?
Well, it's almost double dipping. A lot of times when I was in the public sector, I'd always be asked from clients, how can we double dip? How can we get two different benefits from doing one thing? And a lot of times the answer is you can't, at least legally, to do that. This is one of those situations where you actually can. You're going to get the tax deduction from the donation, but then if it's an appreciated security, you're going to avoid paying the capital gains that you would have paid by selling that security. And you can see by this graphic on the screen here, it's something where there could be, just even on this little amount here, it could be thousands of dollars of tax savings by doing this, and you're kind of fulfilling your desire to donate. So it's almost three benefits from it.
Right. I call this a way to give yourself a free step up in basis. I remember having this conversation with a client, and he had all this Facebook stock that he bought years ago. And he's talking to us about needing to make some gifts to his children's school. And we said, well, why don't we use the Facebook stock? And he said, oh, but I really want to hold on to it. Look how much appreciation it's had. I said, how about this? We get to donate the stock. We get rid of all of that appreciation. We throw it into your donor advised fund. You don't have to pay capital gains tax. And we take the cash that you would have donated anyway to buy back the Facebook stock. So effectively giving yourself a free step up in basis. And he said, but I like to see all that appreciation when I log into TD, and it just feels good that I bought this 15 years ago. I said, well, we'll print it, we'll frame it, and then you can remember forever that you had all of this appreciation. But we got a really significant tax savings out of this strategy. So this is fantastic. So we like double dipping, and we like to have triple benefits. And I think loss harvesting comes along the same lines. Let's talk a little bit about what loss harvesting is and when we can start implementing a loss harvesting strategy.
Sure. I mean, just kind of what the name would entail, loss harvesting. You want to kind of accumulate these losses from securities that may be down and offset it against capital gains. And kind of as you mentioned on the last slide or two, is that it's something that where you have to be forward looking. In the current year, you might only get up to the $3,000 loss that you can deduct for doing the loss harvesting, but maybe coming down the pike in the next year, you have a huge capital gain that's going to be coming, and this is something that can be offset in next year's tax year, even though you're doing it this year. So it's something that's it's always something that you need to look at, and especially at a time where some securities may be down. It's a good time to harvest some of these losses.
Yeah, I look at market downturn as the tax gods giving us an opportunity to do really meaningful planning. So these tax gods have been really busy because the market has been down, unfortunately, and nobody likes to see that. But this is really a way for us to make lemonade out of lemons, right? We can't control that the market has behaved the way it has behaved this year, but it would almost be insult to injury if we didn't take advantage of current market conditions to give ourselves a significant tax benefit. And the nice thing is that these losses can be used to offset gains from any other sources. It doesn't have to be portfolio gains. I had someone who sold their main residence and the gain was way above the exclusion. So there was a taxable gain, except that with the current market downturn, we were able to harvest enough losses to pretty much wipe out the entire gain from the sale of this real estate or the sale of a business. So we've had clients sell their business early in the year, $1 million, $2 million gain, and we have been really actively chipping away at that taxable gain by harvesting losses in the portfolio. And this, you have to be careful, right? Because if we don't do it correctly, we face something called the wash sale rules. So if you're going to try to harvest losses, just make sure that you are aware of the wash sale rules so that you don't get unpleasantly surprised when you get your 1099 at the end of the year and you see that you thought you were going to get all these losses, and then the IRS says to you, sorry, you bought it right back, and effectively you're not able to deduct that loss. So you have to be careful how you implement a loss harvesting strategy. Let's talk about this one. We talked about itemized deductions and how to bunch all these deductions into a year that we're absolutely getting a benefit. But even better than being able to itemize our deductions are any deductions that are above the line. So maybe walk us through, Lonnie, how health savings accounts work, who's eligible, how do you take advantage of that?
Yeah, absolutely, Nella. This is definitely an area where I feel like there's a missed opportunity for a lot of taxpayers in general. And I just recently had a conversation with a good friend of mine about this, and he was actually eligible with his healthcare plan for an HSA, and he's going to be doing it for his family and putting in the $7,300 contribution. And like you said, almost to the point where even if you don't need the money, you can still put into it. You get the tax deduction whether you itemize or not. And then the earnings inside of this are going to grow tax-free as well. So again, another one of those things where, hey, where can we double dip? This is another legal way that you can do it, and it keeps rolling over. Another question I get, how does this compare to an FSA versus an HSA? And it's something that this continues to grow. It rolls over, and at some point you're going to have medical expenses that you can take out the funds tax-free to use on. And there's a large variety of things that would be considered a medical expense. It's not super limited, so this is a great tool.
Yeah, I call this the triple dip. I'm going to call it the triple crown of savings account, because we're getting that deduction on the way in. That's above the line. This thing is growing tax deferred, and then the distributions will be tax free if we use it for medical. So it really is an amazing way to take advantage of the only really legal tax shelters that exist. And I think the way that you really take advantage of this is if you're able to continue to accumulate those assets in the health savings account and you invest it. So this is great. Now you're pumping as much as you can inside your HSA, but you're not utilizing it for current medical expenses. You're basically saving all those funds, you're investing it and growing it so that when we retire at 60, 65, or 70, and we're ready to pay for any insurance or co-pays, we can use it later on. So that's really where you're able to boost the use of a health savings account.
You just have to really make sure, Noah, that and we tell this to our clients, you have to check with your health insurance and make sure that it's a healthcare plan that's an HSA eligible healthcare plan, because the last thing you want to do is open an HSA, contribute into an HSA, then find out that you shouldn't have done it, because it's a big that could become a big problem for you. So
Absolutely. And I
yeah.
think you just reminded me, Lonnie. So just because you have a health insurance plan that has a high deductible, it doesn't necessarily mean that it is HSA eligible, right?
That's correct. Yeah, it actually, the insurance plan would specify if it's an HSA eligible plan or not. And sometimes through an employer they offer an HSA plan and they make the contributions for you through the W-2 as a payroll deduction. And sometimes the employer may have an HSA eligible plan, but they don't offer the HSA, and you open one uh, outside of there and do the contributions yourself. So again, just like the theme of the presentation, it's holistic depending on the client, but this is a huge opportunity that can grow and do good things way down the road. So
Yeah, and when we're talking to clients about, well, what happens if I don't end up using it? You leave it to your spouse, and your spouse is able to get all the same benefits. But we do warn those that are already in retirement that they should start using it in those later years, because when they leave a health savings account to children, it's like the Jekyll and Hyde. Then you get the Hyde part, and it becomes a really nasty account. It's all taxable when someone inherits it. So you have to be careful with health savings account, know when to start accumulating, and then more importantly, know when to start drawing down on it. So, talking about taxes and how we're going to cover that tax bill, this is a good segue into, how do we plan to pay for our taxes for the current year? Let's talk a little bit about withholding. Maybe I didn't make those estimated payments. I'm short. Someone's run some numbers here. What can I do now?
well, no, withholding through a W-2 is kind of the taxpayer's best friend, I guess, if you will, on that. So when you do withholdings through the W-2, it annualizes the withholdings as if it was done throughout the whole year. So how do you maximize that strategy to avoid underpayment penalty? Which to add, to this slide, the IRS actually upped the penalty that they're charging for underpayment. It's up to 6% compounding daily. So, this, if it's a large number, this could be a substantial penalty. And it's just another planning technique that we will look at and say, okay, you know, if you're, and again, the employer has to allow this to happen. The payroll company has to allow you to kind of bunch it toward the end of the year, but you can do a big withholding at the end of the year, and it would show as if it was annualized and maybe avoid some or all of the underpayment penalty.
Yeah, and that makes me think about business owners who are able to control the salary that they're drawing from their S corp. So this is why year-end planning is so important, because you would now have a really good sense of how the year turned out. How profitable are you for the year, and then how much you should have paid in. So if you're short, you can always go ahead and process a bonus at the end of the year and cover all the tax. So it's a magical way to kind of turn back the clock and pretend you did make those estimated tax payments. I also like to talk about IRAs, because we generally like to preserve our clients' required minimum distribution and then do them now after we've worked up projections and we have a better sense of how much they're going to owe, for those same reasons, Lonnie, because then if a client has to take $100,000 RMD, now we can better plan for how much do we need to withhold from that RMD based on dividends, interest, capital gains, if there are any. So now we have the power of hindsight in our favor, and we can really plan around that withholding. And and I'm gonna
Absolutely.
say this before we move on, because I do have some clients that say, you know what, Nella, it's all well and good. You told me I should pay in 100,000, but I can have better use of those funds because I'm doing A, B, and C. As long as you understand that you're gonna pay interest, that the IRS calls the penalty.
That's correct. Yeah, and it's constantly changing just with everything else. As you can see, 5% to 6% just for one quarter. They can come back in the first quarter next year and raise it to 7%. So it's just something, why pay it if you don't have to?
True, true. So speaking of IRA and required minimum distributions, this is another one of my favorite strategies when it comes to planning around IRA distributions. And maybe you can walk us through what is a qualified charitable distribution? How do I do it? What are the pitfalls? What do I need to be careful with?
Sure, of course. I mean, this is a great strategy. If you're the type of person that likes to do donations each year, and you're also the person who's in the situation of having to take an RMD, you can kind of couple the two of them together and get your donation that you were looking to do anyway, but then at the same time, reduce your RMD by the amount of this donation. So again, you don't have to worry about standard deduction versus itemized deduction. It just takes it right off right off what the RMD distribution would have looked like. So again, this is a huge tool. Again, there are some limitations to it, that it's $100,000 of qualified charitable distributions for an individual, and if you're married, each spouse can do up to $100,000. So it is, again, a very good tool. One thing that people really should note, it is a normal donation. So wherever this donation is going to from your IRA and from your RMD, you got to still get the proper backup from that organization showing that made the donation. They send you the letter, haven't received any goods or services in return, and it's important to have that should you ever get audited.
Right, because I think one of the things that we've caught when we review clients' tax returns is that they did a qualified charitable distribution, or QCD, but yet the tax return shows that the full required minimum
Yeah.
distribution was taxed. And why is that, Lonnie? Why does that mistake happen so often?
To be honest, communication is the number one reason why that happens. One thing that we always recommend to our clients is tell your CPA that you're doing it. Let them make a note in the file, because a lot of times what'll happen is the 1099 will come at the end of the year. It'll show the whole amount. It'll show it all as taxable, but in reality, the 1099 is showing incorrectly, and there's a portion of that was a qualified charitable distribution. And when you look at the first page of the 1040, and you see the distribution on there, it'll be less by the QCD. And actually, some tax softwares even put QCD on the page to show that it happened. So it's important for that, because what it does is that it helps you to not have to go back and amend the return and keep statutes open. So it's something that just a simple communication could avoid a problem down the road.
Right. And so sometimes what we do, and this is something I recommend just because it's easier to track, we would open up a separate IRA with a checking account capabilities. So that IRA with checks is the one the client is going to use to make their donations to American Red Cross, wherever their donations are going. And this way, that one account which has checkbook, they can write the check directly to the charity. Remember, because it has to go to the charity, and then they can just pull the detail for that account for the whole year, give it to the CPA, and then they see that all of the amounts that came out of that IRA were all charitable gifts. So that's a good way to track it.
Sure.
So, we talk about any magical way to reduce our income above the line, and that is the health savings account, the use of QCDs, and another one is the use of solo 401ks. Maybe tell us a little bit about who needs to think about this, and what are the benefits of implementing a retirement plan if you are a business owner, you have consulting income. How does this work?
So again, and pretty much what you just said. Who should think about this? It should really be businesses, business owners, small businesses. Pretty much if you own a business or you're self-employed, these are different vehicles that you can utilize to still have a tax savings. Again, and you can see it right on the screen here. There's different variations and rules for each of these accounts, and what it might be better for. For example, solo 401k. One owner of the business doesn't have any employees, you can just dump into the solo 401k. It has very high limits of what you can put into it. And again, something that a lot of people don't think about when they talk about doing these accounts is some are easier to manage than others, and some are less costly to manage than others, and some have different reporting requirements internally, the plans, than others. So different things here. SEP IRA, again, you can do it right through the business. The contribution can actually go through directly, and again, a few employees, for example, simple IRA, as you see, the biggest difference, up to 100 employees, and now there can be matches and other things. So what I would say to sum up this slide is that, again, we have to look at it individually, on an individual basis. Look at your business, look at your individual situation, and then run scenarios with whatever ones you might be eligible for, and see what would suit you best.
Yeah, and the takeaway here from me is don't just go open these, um, just because you heard it here and it sounds like a great idea without checking what the implications are across the board. We've seen that a lot. We had a client who he says that he told the financial institution that he had selected open up an IRA, is what he thought he selected. I want to open up an IRA. He went and did it himself. And apparently he checked the SEP IRA box. And when he comes over, he shows me the accounts. I nearly fell off my seat because he had like 20 employees. So you can't set up a SEP IRA and not do it for all of your employees. So just be careful, make sure that before you open up new accounts and start contributing, that you know what the how they work and who you have to fund it for, because that's pretty significant tax implications there.
Yeah, and even so, even these on the screen on that slide, Noah, there's other ones too. There's other methods too for self-employed individuals and other accounts that could be used to utilize tax planning strategies appropriately. So again, like you said, just talk to us or talk to your advisor.
Yeah, and I love that you brought that up too, because I nearly forgot, believe it or not. So like if you're expecting significant income and for a few years, we don't have it here, but like a defined benefit plan is the retirement plan for a solo person on steroids. This one, the contribution levels are insanely high. I mean, it could be up to 200, 300,000 that you can contribute into those types of accounts. So that's where the tax savings are pretty significant.
Yeah. Schedule C, we have a client actually that comes to mind that wipes out pretty much all of his taxable income by doing that from the huge income he gets on a Schedule C as being self-employed. So
Exactly.
great strategy. Yeah.
So I want to talk a little bit about, while this is not income tax savings, this is one of those things that it is a use it or lose it. So I like to bring it up at year end. It's part of our agenda for every client that we're meeting with now. If we're expecting that you'll have a taxable estate, you have the, if you're facing a potential estate tax, then one of the things that we like to do is make sure that we are on an annual basis taking advantage of annual exclusions. So let me step back. If you expect your taxable estate to equal or exceed 12,060,000, which is the current level of the exemption, then implementing a plan where every year you're utilizing your annual exclusion for gifts to your kids or grandkids, 529 plans, all sorts of different strategies. You want every single tool in the toolbox to try to chip away at your taxable estate. And this is so important because while $12 million seems like a pretty high number, we are facing a potential drop in the estate tax exemption when we get to 2026. So we really need to think about not just the here and the now, but what are the changes down the road that can impact our taxable estate situation? So 16,000 is the amount that you can give away to everyone and anyone. And if you're married, you can actually double this. So 16 from you and your husband, you and your wife, and then that means 32,000 a year per donee. And these gifts can go into a 529 plan. They can go into a trust. So there's many different ways to accomplish this. I do caution people, if you have a trust for your life insurance policy, then those gifts that you're making into that trust is eating into this annual exclusion for those beneficiaries. So just be careful. You don't want to double dip, because if we double dip on the annual exclusion, we're essentially eating into our lifetime exemption. So you have to be careful. But the other reminder is that if you pay medical expenses and education expenses directly to the institutions providing those services to your children or grandchildren, those don't count as gifts. So that is another nice way to double dip, right? We pay all of the medical expenses, all of the tuition directly to the school or the hospital, and then we could still do our annual exclusion. So most people forget that that has an unlimited exemption. 529 plans, every time our clients have a new grandchild, we're kind of rushing to set these up. And the nice thing about 529 plans is that not only can you do the $16,000 annual exclusion, but with 529 plans, you can actually front load 5 years worth. So that's pretty significant, because that means, you know, you're pumping 150,000 in one shot, and this thing is going to grow tax deferred for the lifetime of that child, so they can use it for college in 18 years. And we talked about life insurance policies. Just be careful if you have a life insurance trust and you're making those premium payments, because that does count as part of your annual exclusion gift. Anything you want to add there, Lonnie?
Just other than from the putting the tax hat on from the compliance side, you know, and some of this might actually require a separate filing on an annual basis. So again, it's just something that not only talking to the advisor, but also to the CPA to communicate.
Yeah, and I love that you brought that up, because I only remember that we do have to file a gift tax return after we're reviewing all the gifts and say, oh, yikes. But if you're making gifts, let's say you agree that you're gonna use both yours and your spouse's annual exclusion. So you're gonna give 32,000 to each of your kids. If you do this from an account that's just in your name, you still have to file a gift tax return, because you do have to make a special election to split that gift with your spouse. Otherwise, the IRS is going to treat it as you only made the gift, and so it's over 16,000, and they're going to reduce your lifetime exemption because you didn't make that election to split gifts with your spouse. So just be careful where the gift is coming from. My rule of thumb is that if it comes from a joint account, then I think you're fine. But if it's coming from one person's account, then you need to make that election to split gifts. Let's go a little bit into stock options. The reason why running projections is so critical is because if you do have any type of incentive stock option or non-qualified stock option that's provided by your employer, this is the time to look at whether, you know, are the options in the money? What is the tax implication associated with exercising those options? If you are in AMT, and that's kind of, that whole phrase has disappeared, but, and the reason why is because one of the big things that would contribute to someone going into AMT and being subject to the alternative minimum tax was their state income tax deductions. But as you all know, now you can only deduct $10,000 of property taxes or state income taxes, because there's that $10,000 cap. So not that many people are facing AMT, but if you are facing AMT, then this is the time that you need to look at the tax implications of exercising these stock options, because you almost want to take advantage that you are in AMT to possibly accelerate income. And that sounds crazy, because normally we think about year-end tax planning as an opportunity to defer income and accelerate deductions. But if you are an AMT, it may behoove you to actually accelerate the income and pay tax at 28% instead of 37. So again, this is why everyone's situation is so different. And depending on the issues that affect you, the planning might look very different. So this is something you don't want to lose sight of. What we try to do is we use a system, a program to kind of throw in everyone's stock options, track which lots are in the money, track what is the, what's the current fair market value of the stock, what's the stock trading at, and then look at what is the impact if we exercise this year. Do we exercise and hold? Do we exercise and sell? So there's so much to consider. So you don't want to lose sight of your options, because even in the current market environment, there may still be opportunity to go ahead and exercise those shares. Lonnie, let's see. I don't know if you want to take this one, passive activity loss rules. What are things we should be looking at as we're working through year-end tax plans related to what is a passive activity loss, and what do we want to look at before December 31st?
Right, of course, Nella. So for the most part, when people think of passive income, they think of rental properties, and for the general rule of thumb, as you can see, the passive losses are only deductible against passive income. So aside from the idea, which we can talk about, if you're selling the property in the year, then the losses all open up. You might be carrying forward losses for quite some time, and as it says here, they expire with the taxpayer. So it's one thing you really have to consider. It's not something that's just gonna keep going indefinitely. At some point, you need to find a way to open up those passive losses and utilize them. But again, rental properties, depreciation and passive income and losses, it's another type of tax strategy. But again, it's something that you really have to make sure that you are passive in it. So it's just really something to think about.
Yeah, and I love that you brought that up, because people don't realize that. But even if you, so maybe let's kind of flip that a little bit. So by definition, any rental is passive. That's the IRS general default. But there are certain situations where you could be deemed a real estate professional. So this is something that could change on an annual basis. Maybe this year, this is all you did and you kind of met their safe harbor rules. So now you can technically be classified as a real estate professional, which would change the classification of that income. And if the income is passive, it's subject to another layer of tax, which we didn't talk about yet, but there's that net investment income tax of 3.8%. So passive may not be a good treatment if it's positive, because you're paying another layer of tax. So that's when maybe you would want to see if you qualify as a real estate professional, because then you can avoid this additional 3.8% tax. But sometimes, what I've noticed is that if a client consistently has a property that has a carryover loss year after year after year, we question, like, hey, can we dispose of this so that we can release those losses? Like, is this entity really going somewhere? Can we sell it and then just be able to trigger once we check the box that the activity has been disposed, all of the losses associated with that activity are allowable in the current year. So that's something to look to. And then the last thing I'll mention here is that sometimes, because of the software, you may have an active business, but if maybe the tax prep software, there's a little box that you have to indicate that it is trader business. And if that box isn't checked, be careful, because sometimes it'll subject active trader business income to that additional 3.8% tax. And that's something we've been catching a lot here. We always go to that one form and see if the program subtracted it out. So just be careful with that. But we could spend the whole day on passive activity rules, but I don't want to put you all to sleep, so we'll move on. And I'll take this one. This is one of my favorite things to talk about, because oftentimes we don't think about tax planning and investing as one and the same, or, oh, why does that matter? Set up the portfolio, give me the allocation. I want to be aggressive. I want to be conservative. And people are not really thinking about, well, there's a tax planning component in setting up a portfolio. So this is something where it's going to be the difference between you keeping 100% of portfolio growth or 60% or 50%. So this is tax efficient investing. So rather than if you have three type of accounts, let's say you have your taxable brokerage account, it's joint, you and your spouse, and then you each have an IRA, which is a tax deferred account, and then you have a Roth. So you have a taxable account, which means that all the income that that account earns is taxable to you on an annual basis because you're going to get a 1099 from TD or Schwab. And then you have a traditional IRA, which it's not taxable currently. It'll be taxable later on when you take distributions. And then you have a tax-free account that will never be taxed. So you have to try to take advantage of the classification of these type of accounts. So in a taxable account, you want to invest in things that kick off qualified dividends that are taxed at 15 or 20%, long-term capital gains, right? Because that's going to ensure that the growth in that taxable account, you get to pay as little tax as possible. In the tax deferred account, you want to think about investing in things that generate ordinary income because that's not taxed to you today. It's going to be taxed when you take those distributions in the future. And then in your Roth, you want to think about investing in things that are projected to have astronomical growth so that this thing is multiplied 10, 20, 30 times. And later on, when you take distributions, is tax-free. So think about tax efficiency even as you're investing, which is something that most people don't bring together. Anything you want to add there, Lonnie, on tax efficient investing?
No, I think you hit the nail on the head. Again, it's one of the eye-opening things that when we talk to clients about this, they don't realize that the two really don't just go hand in hand. They're actually just one and the same almost. And you have to look at this when you do this, and it's imperative.
Yeah, and I've heard of people just coming up with an allocation and literally just applying it. You know, this is the allocation. If it's 70-30, here's in my taxable account and my IRA and my Roth, and that's not really efficient. So you want to think about, even with munis, now that, as you all know, rates are higher. And so you might be looking at situations when you can get a really nice yield using municipal bonds. And so if you're going to have bonds in your taxable account, then maybe look at whether it makes sense to have taxable bonds versus municipal bonds because there's different tax treatment. And we could spend all day on this as well. I want to end here and give a couple of minutes to any questions. You all have a chat box. If you have any questions that you'd like Lonnie and I to make sure we address, now would be a good time in the next 6 minutes. I'm not seeing any questions here. I don't know if you are, Lonnie, on your side.
No, and to add to that, Nella, I mean, if anybody thinks of something even after the presentation, we are here to help. So, give us a call, email us, and schedule a meeting to come in, whatever is most appropriate for you. But like Nella said, this is our area where the magic happens. So whatever we can do to help, we're here for everybody.
Excellent. So I guess we must have done such an amazing job thoroughly covering everything because I don't see any questions in the chat, and that's new. So with that said, we will give everybody 6 minutes back. Again, call us if you think of anything after the fact. It has been a pleasure spending this afternoon with you all. Have an amazing rest of your day and happy tax planning season.
Yes, thank you. Thank you, everybody.